Hello, good afternoon, and welcome to this webinar about self-assessment essentials for limited company directors. My name's Emily Coltman. I'm FreeAgent's Chief Accountant, and I'll be delivering this webinar today. I'll be talking, as I say, about the key essentials if you are drawing up a tax return and you are the director of a limited company. A few housekeeping points. I am using FreeAgent purely as a visual here. This is not going to be a FreeAgent sales pitch. I won't, I'm afraid, be able to take questions from the floor due to the number of people we've got on this call today. What I would say, though, is that we've got a blog post on our website that contains frequently asked questions by people who are filling in tax returns. So please do have a look at that. There's also lots of other useful information on our website that will help you when you're filling in your tax return. The other point to note is that this webinar is not about how to get your books into FreeAgent, how to keep your books on FreeAgent. We do have a webinar about that, which is at this time next week. That's Thursday, the 23rd of January at midday. So if you're interested in getting your books up to date on FreeAgent to file your tax return, please do join us for that webinar. In this webinar, as I say, we're going to talk about key essentials for self-assessment using FreeAgent purely as an aid memoir and visual. So let's get stuck in. First and foremost, do company directors always have to file a tax return? Simple answer, the kind of tax return we're talking about, the answer is no. You would have to do a tax return if you are earning from the company. If you're taking a salary, you'll probably be asked to fill in a tax return. If you are taking dividends from the company, if you're also a shareholder, then you would almost certainly have to fill in a tax return. But if the company's not trading, you're not taking a salary from it, it's not paying you dividends, it's not reimbursing any expenses for you, HMRC may well not ask you to do a tax return. What I would say is if HMRC ask you to fill in a tax return, it's easier to fill it in than it is to ask them to take you off their list. If you do a tax return and they see that they already know about all of your income, what they'll do is they'll write to you and say you don't have to fill in a tax return anymore. But I would say if you get a letter from HMRC asking you to fill in a tax return, fill it in. Because if they're expecting you to file a tax return and you don't file one, even if you don't have any additional tax to pay, they will still fine you £100 if your tax return isn't filed by the end of January, and they will go on fining you with fines ramping right up. People have been fined over £1,500 for not filing a tax return, even when they don't have any tax to pay. So what I would say is if HMRC ask you to do a tax return, do a tax return. What I'm also going to say is which tax return is it we're talking about? This is yours, your personal tax return. What I'm not talking about today is the company's tax return. A limited company always pays what's called corporation tax on its profits. That is, its income less its day-to-day running costs. So here where I'm looking here are corporation tax returns within FreeAgent, which look something a little bit like this. What we're talking about today is not the corporation tax return. What we're talking about is your own personal tax return, which contains details of your personal income. So as the director of a limited company, the income you would take from the company would be a salary. It would be dividends if you also own shares in the company and the company's made enough profit to pay you a dividend. The company might also reimburse you expenses. Sometimes you would and sometimes you wouldn't need to report those on your tax return. Any expenses you've incurred on behalf of the company. I'll talk about that just shortly. But as for the business's income and day-to-day running costs and so forth, when you are operating your business through a limited company, those do not go on your tax return. They go on the company's. It's sometimes hard if you are the only individual involved with a company to separate out in your mind what is yours and what is the company's. But if you are operating your business through a limited company, any work that you do, the company would be earning the money for that. So when you issue invoices in the company's name, that's the company's income and it goes on the company's tax return, not yours. What you want to put on your tax return is just literally the money that you earn from the company, not the money that the company earns from its customers. And as I say, that is not an easy concept to get your head around if you are the only person involved with the company. But it makes no difference whether it's just you involved with the company or whether you're working for a company that's got lots of other people involved with it. This is your income on your tax return, not the company's. If I could give an example of that, I work for FreeAgent full-time. So what I would be putting on my tax return would be my salary from FreeAgent. I also have another company of my own, which is called Accounts in English Limited. Accounts in English Limited, I am the only director and the only shareholder of that company. If I was earning a salary from Accounts in English Limited, it would be that salary that I would put on my tax return. Any income earned by FreeAgent or by Accounts in English Limited, by invoices, does not go on my tax return, it goes on theirs. So hopefully I've made that point sufficiently clear. I'm going to move on now. And what I'm going to do is to pick up some of the key points about completing and filing a tax return as they would apply to the director of a limited company. So how a tax return is laid out is you have one form called the main return, sometimes also known as the SA100, which is what we're looking at now. And it always covers income for the tax year, otherwise known as the fiscal year, which is the period from the 6th of April one year to the 5th of April the following year. If you're filing your tax return online, it's got to be filed by the end of January following the end of the tax year. So that is the 31st of January 2025 for this particular tax year, the 6th of April 2023 to the 5th of April 2024, commonly known as 2023 to 24 for short. So that is the tax year we're looking at. And what you're going to report on your tax return is all of your taxable income, even if HMRC already know about it. So if you are the director of a company and you're taking a salary from the company, you will almost certainly be preparing a payroll for the company and telling HMRC by filing your payroll reports online every time you take a salary from the company. HMRC already know about that, right enough, but you've still got to put it on your tax return because the aim of the tax return is to give HMRC a complete picture of all of your taxable income all in one place. I keep saying HMRC, that is HM Revenue and Customs, in other words, the taxman, the UK's tax authority. So that is the fiscal year and when a tax return has to be filed. Any tax you might have to pay over and above what you've had taken off your salary is also due by the end of January. You might also have to make a payment at the end of July in certain circumstances, but that's a bit rarer for company directors than it is if you are a sole trader operating a business that's not going through a limited company. So that is the main return. And what you then have are what's called supplementary pages, which you can see up here. Supplementary pages are where you report other kinds of income that don't go on the main return. The main return includes common types of income like interest and dividends that lots of people get. It also includes what's called common tax reliefs, which are how you can save a bit of tax. Whenever you hear someone say tax relief, it means they're saving some tax in a particular way. Some kinds of tax relief reduce the total income you pay tax on. Others reduce the actual tax itself, but tax relief is always going to be a way of saving tax. So on these supplementary pages, you report for each kind of income that you might have that's not going on the main return. You report in things like income from a job. As a company director, that would include your salary. If you are a sole trader, you would do self-employment pages. If you rent out a property, you do UK property pages. By the way, when I say if you rent out a property, as the director of a company, be a bit careful with that. Remember, this is your income. If the company rents out a property, that's got to go on its corporation tax return. This I'm talking about here is where the property is in your name, not the company's. There are also other kinds of supplementary pages. For instance, if you receive foreign income over a certain level, if you're a minister of religion, if you have income from a trust, and so on and so forth. But I won't be talking about those today. So everybody who has to fill in a tax return must do the main return. And then you do supplementary pages in accordance with what other income you've earned. Today, I'm going to focus mainly on the main return and on the employment pages, because those are more crucial for company directors than the other sets of pages, unless you've also got that kind of income. Okay, so let's have a look at the main return. So as I say, the main return contains the most common kinds of income and tax relief. It also contains information about you as an individual. Tax rates you're subject to. Are you subject to English or Northern Irish tax rates, Scottish or Welsh ones? That depends on where you live, where in the UK you live, not where your company is registered, not where you identify as coming from, where you live. So I'm English, born and bred in England. Accounts and English Limited is registered in England. I live in Scotland. Therefore, I am a Scottish taxpayer. Let's have a look at some of the key income and tax reliefs on the main return. Bank interest. Few points to note here. Firstly, and I know I keep labouring this point, but as an accountant, I've seen people get confused so many times between what's theirs and what's the company's. This is interest on accounts that are in your name, not in the company's name, your name. There's different boxes for interest that you've received on your bank account, depending on whether the bank took tax off your interest before they paid it to you or whether they didn't. If you have a joint bank account with a spouse or a partner, you would put in a half share of whatever interest that account earned. Don't get confused between interest that hasn't yet been taxed but is still taxable and interest that isn't taxable. In the latter case, what I commonly mean by that is an ISA. If you've got an ISA and you earn interest on an ISA, you don't have to put that on your tax return at all because it is not taxable income. Sometimes the bank just doesn't take tax off before they give you the interest, but that interest is still taxable. How on earth do you know the difference? On your bank's paperwork, it should say whether the interest is subject to income tax or not. If it's not on the paperwork, the bank should be able to tell you. And if they've taken tax off, they should give you a statement showing how much tax they've taken off your interest before they gave it to you. Dividends. This is quite important as the director of a limited company. If you are also a shareholder in that company, which is 9 times out of 10 the case if you are the only individual involved with the company, you will quite probably be the only director and the only shareholder. If your company's a bit bigger, it might have several directors and several shareholders. It's shareholders who receive dividends. And this is always going to be the dividends that you received or were due to receive during the tax year, 6th of April to the 5th of April. Don't get confused and think that that should be the dividends for your company's accounting year, the period for which your company draws up its accounts. No, it's not. It's always the tax year that you report your dividends for on your tax return. Quick sidestep, you can see there that FreeAgent has pre-populated that for me. That's because I'm using FreeAgent to keep this company's books, so it knows how much this user has received as dividends within the tax year. So it knows that number. There's also a separate box for any other dividends. So this might be if you've got a portfolio of dividends, perhaps you've got some investments held in stocks and shares, not an ISA, remember, but anything else, any other investments in stocks and shares, if you've received dividends, you put that on your tax return. So that is UK interest or dividend income. Contributions to pension schemes. Something to be aware of as a company director, if you've got pension coming off your salary, you only would need to fill that in, and FreeAgent will gross it up, but there's plenty of software that doesn't. So just be careful which figure you're entering here. It might be the amount you actually paid. It might be the total amount, including any tax relief that's available. depending on which software you're using, because different software packages approach it differently. What I would say, though, is you only need to fill that box in if your pension contributions coming off your salary are what's called relief at source contributions, and you're a higher rate taxpayer. In other words, you're paying tax at 40% or higher on some of your income. Other than that, there's no advantage to putting any pension contributions that came off your salary onto your tax return. And if, by the way, you're operating your pension through salary sacrifice, you certainly don't put that on your tax return because you've already had the tax relief you were entitled to. Donations to charities. If you make a donation to charity under gift aid, you put it here. And there's also various other charitable donations you might be including. Student or postgraduate loans. If you are due to repay a student or postgraduate loan, then you need to highlight that on your tax return. You may well have had some student loan repayments already taken off your salary because you're being paid as an employee by the company. So you need to put any deductions that your employer has already taken into that box there. But if you've received income that HMRC don't yet know about by the time you fill in your tax return, such as dividends from your company, then you may well have some extra student loan repayments to make, along with any extra tax that you might have to pay. And so you need to make sure that you filled in those boxes correctly. What I'm going to do now is highlight this particular point here, which is quite important for you as a company director. It's all about how you want to pay any additional tax that you've maybe not yet paid. When the company runs your salary through its payroll, it'll take a certain amount of tax off your wages and pay it over to HMRC under the PAYE scheme, PAYE pay as you earn. What you can do is you can ask HMRC to also take any extra tax that you might be due to pay off your salary. So, for instance, you already would have paid tax on your salary. Suppose you've also taken a dividend. HMRC wouldn't know about the dividend, so you'd have to pay any extra tax at the end of January and possibly also something on account at the end of July. What you can do instead, and this would have to be for future reference for next year, but what you can do instead is ask HMRC instead to take any extra tax off your salary. How they'll do that is they will change your tax code. Your tax code is a series of numbers that you give to your employer, in this case, the company. You give your tax code to your employer, and that, when they put it into their payroll software, makes the software work some magic and take the right amount of tax off your salary. If the tax code is changed, it can take more or possibly less tax off your salary. What we would be doing here would be, we would be saying, okay, I will pay some more tax each time I get paid, so I'll get less in my pocket each month, or however often my employer pays me, but I won't have tax to pay or won't have so much tax to pay at the end of January. Well and good, but HMRC will only accept that instruction by a certain time. You can see there we've got a warning that after the 30th of December, any outstanding tax can't be collected by changing your tax code. You have to pay it in a lump sum at the end of January. So it's too late to say, I want to go through my tax code for this tax year, but you might well be able to do it next year. You would just need to make sure and file your tax return before the 30th of September. And also the amount of tax that you owe has to be under £3,000. If it's over £3,000, HMRC won't even try to collect it through your tax code. They say you've got to pay it in one lump sum. So that is the main return in a nutshell. What I'm going to do now is address some of the key elements of the employment pages, which as a company director, you would need to fill in with any salary that you have taken from the company. The company's payroll software would produce for you what's called a Form P60. And on a Form P60, it would have your salary and tax taken off your salary highlighted to show these are the figures that you should put on your tax return. I happen to have used FreeAgent's payroll engine for this company's payroll, so it's pre-populated those fields. If you're not using FreeAgent, then you would need to get hold of your P60 from your employer, that is your company, and you would need to fill in those details. If you have another job as well as what you earn through your own company, you would need to set a separate set of employment pages for that job. Report each job on a separate set of employment pages. Don't add the figures together. Separate employment pages for each job you have. If you left that job before the 5th of April 2024, but after the 6th of April 2023, your employer will have given you what's called a Form P45 instead of a P60. The P45 does also include your salary and your tax and highlights them for which boxes you need to fill on your tax return. So that's what you would be filling in, your pay and any tax taken off your pay. Benefits from your employer, that would be if you get what's called a Form P11D. And these are for what we call non-cash taxable benefits. What does that mean? It means things the company provides you with that aren't cash, which HMRC says they want some extra tax on. This all came about because certain employers started paying their staff in gold bullion bars, would you believe, on which HMRC didn't know how to work out the tax because it wasn't cold hard cash. HMRC said we can't be having this and developed a system of taxable benefits. So taxable benefits are when you have to pay tax on the value of a benefit that you receive from your employer that might not be cash. So that would be things like a company car or private medical insurance or things like that. Not all benefits are taxable. For instance, a company can provide, if it's got more employees than just one, a company can have a canteen and provide lunches for its staff. And so long as all staff can eat in the canteen on equal terms with each other, that's not a taxable benefit. Where this comes unstuck if you are the only director of your company is HMRC would probably look askance at you trying to include that as a non-taxable benefit if you're the only director. I mentioned expenses that you incurred. You would only put those on your tax return if your employer, in other words, the company, is not going to pay you back for them or is not going to pay you back as much as you paid. For instance, business travel and subsistence. You might, for example, travel on business for your company. The company might have a policy that it will reimburse mileage at 20p a mile. From a tax point of view, HMRC says that there's no tax to pay if you reclaim mileage at up to 45p a mile for the first 10,000 miles in a tax year, 25p a mile thereafter. That means you're entitled to tax relief on more than you're getting from the company. So what you would do then is to put into this box the amount of mileage that you could claim. So that's the number of miles at 45/25p a mile. And then put in here the amount that you actually got from the company. That's the 20p a mile. What will happen then is you'll get tax relief on the difference. You'll save a bit of tax. So that's good news. If your company has a policy, as I say, for reimbursement for less than the total. But if you are incurring expenses and the company is paying you back for what you've incurred, don't put that on your tax return. So that is the employment pages, or the key points. I'm going to briefly touch on these other two pages here, the self-employment and UK property. Self-employment, you only need to fill that in if you also have a sole trade business as well as the company. Don't be confused into putting the company's income and costs on the self-employment pages. Why not? Because you'll pay tax on them twice if you do that. You'll pay tax on them because you've put them on your tax return. The company will also pay tax on them when you put them on its tax return. And before you ask, it's not a good idea to put them on your tax return so that you don't have to bother doing a tax return for the company. For one thing, you'll get fined for not submitting a tax return for the company. And for another thing, the company may well pay less corporation tax on profits than you would pay on as income tax and national insurance on the profits if you reported them as if you were a sole trader. So I would say don't try and cut that particular corner. It's not worth it. Property income, as I mentioned before, but I make no apology for saying it again, You would only need to fill in the property income pages if you're renting out a property that you own, or possibly that you own jointly with a spouse or a civil partner or somebody else. What you don't need to put on here is rent and costs for any properties owned by the company, because the rental income for that goes on the company's corporation tax return, not on yours. Okay, so now we come to how much tax you might have to pay. So the tax we're looking at here is what we call income tax. As a company director, you might or might not also have to pay national insurance here. You're unlikely to, unless you've also got a sole trade, self-employment, as well as your company. Otherwise, your national insurance gets dealt with through your salary. What we have here then is we add up all of our taxable income. We take off our personal allowance, which is the amount that we're entitled to receive tax-free. By the way, if your income goes over £100,000 a year, you'll start to lose your personal allowance. And then we work out how much tax we're going to have to pay. So we've got some income at what we call the basic rate, 20% south of the border. And then we work out the tax on our dividends. As you can see, that uses different rates. Basic rate for dividend is lower than the basic rate for anything else, but the higher rate kicks in much sooner, because we're only entitled to receive a certain amount of income at the basic rate, and that all gets mopped up by the salary as far as possible. After that, we've only got the last little bit to go as basic rate of the dividend. The rest goes in at higher rate. So that's why we've only got just over 1,000 at basic rate for dividend income. We also have a student loan repay. We've already paid some of that tax on our salary. You might recall that figure from the employment pages. The total amount we've got to pay for this year is just under £11,000. We've already paid 7,000 of that. So what we have to pay by the end of January is the difference, the 3,000. What you might also find, and you're less likely to encounter this as a company director, because a lot of your income you will already have paid tax on through your salary. You might also have to make what's called payments on account, which are payments that are due for the next tax year. But if you have at least 80% of your tax taken on your salary, and student loans don't count towards payments on account either. So that's why this person does not have payments on account to make. They've already paid a lot of tax through their salary. You have to have paid at least 80% of your tax, what's called at source. In other words, you paid it or it was taken off your income before you got hold of your income. And as I say, student loan repayments don't count towards a payment on account. You don't have to make payments on account for those. But otherwise, if your tax is over £1,000, you would have to pay half of it again at the end of January and half of it at the end of July. I just mentioned that in passing, but as I say, you're less likely to encounter it as a company director than you would be if you were a sole trader. So that, in a very brief nutshell, are some key points to help you with filling in your self-assessment tax return as the director of a limited company. Final takeaways: make sure that the P60s and interest certificates and P11D and so forth that you use to fill in your tax return are for the right tax year, 23 to 24. Don't put the wrong figures in by mistake. And always, always remember, this is your tax return, not the company's, so you're putting your income on here. Thank you very much for your time today. I hope that's been useful. Have a good afternoon and good luck with filling in and filing your tax returns. Thank you very much.